Howdy, Jacob here. Today we're looking at Colgate. This is a household products industry, toothpaste. I don't know, they do pet nutrition too. Huh, interesting. Okay. So, company's revenue is a pretty abysmal. No surprise there. Founded in 1806. Is this the same Colgate I was thinking of? Oral. Okay, yeah, it is. Just making sure. I see so many pet information here. I didn't know they sold all that stuff. So that's interesting. But I feel like um, we do see revenue growth up a bit the last couple years. So that's pretty positive. Gross margin, relatively flat, upper 50%. Operating margin, 20%. Very solid. Very solid return on invested capital. Again, a company like this kind of reminds me when Warren Buffett brings up See's Candy or Gillette. I feel like you can have a great return on invested capital, but there's only so much money that can really be reinvested back in the business to get more. When I think about again, I just think toothpaste, but let's bring it back to See's Candy. So in See's Candy, if you made $500 million, they had 20% return on invested capital. You can't just invest $500 million and they're going to buy 20% more candy. And so he had pricing power for sure of just raising prices and was able to sell essentially the same amount of candy, if not, I think it was actually more by the decades later. But in essence, I think a company like this needs to find other avenues to utilize their capital allocation, and they do repurchase a lot of shares, so that also is going to inflate the return on invested capital because the denominator portion gets reduced um, in the way return on invested capital is calculated. But either way, I think that it's a great business, very very solid margins for the type of business it's in of household products. Balance sheet has about $1 billion cash with $330 million short-term debt, $8 billion long-term debt. So that $8 billion long-term debt in relation to free cash flow, $2.5 billion. So less than 4 years. So we're not terribly concerned by that debt figure. The only thing is the company's not really increasing their free cash flow. So I've said in the past, if you just don't increase, if you're at a 5-year free cash flow, 5 times that for debt, and you're able to double your free cash flow, not increase debt, now it's 2.5. But that type of ratio only works if you're really pushing and increasing your free cash flow. And here, I just don't think that they're really going to be increasing their free cash flow that much. And so I do want them to be reducing that debt figure so that they can really focus on deleveraging and becoming just a share repurchase and I guess dividend king stock. So dividend pays out 2% and also pays out almost $1.8 billion free cash flow. The use of cash, a little bit on the acquisition side, but almost 50-50 split between stock, share repurchases, and dividends. So let's make our assumptions here. I think their growth with revenue, 2 to 3%, and then acquisition, let's do 3% there. And then for margins, they've been pretty solid on the margin side. Let's do maybe 14 and 15%. Share repurchases, 1% is 800 million. About $1 billion to offset stock-based compensation. I like that. Terminal PE of, do I think they have some sort of moat? Yes, but growth and reinvestment capabilities, I'll just do right above market average here. Dividend, they've increased that about 2%. I think, yeah, because it's 50% of capital allocation, but what else are they going to do with their cash? So I don't mind them using about, again, roughly 50% share purchases, 50% dividends. Really, it's like 50% dividends, maybe 35-40% share purchases, leaving about 10% to reinvest and make acquisitions. And with these assumptions, we're saying it needs to drop 64% before you get the return we're looking for here. Again, no surprise, just looking at the PE, we're probably at the same margin, and then growth is nowhere near discount rate. So no surprise really, but I do hope you enjoy the video and have a great rest of your day. Thank you.